Hi, I'm Danielle Poli, head of the Product Specialist Group at Oaktree. I'm joined today by Raj Makam, co-portfolio manager of our U.S. Private Debt Group, and Milwood Hobbs Jr., head of North American Sourcing and Origination. Oaktree has been managing portfolios with multiple credit strategies for around 20 years. Most of our focus has been on assessing relative value among liquid credit asset classes. However, we also believe that there is a strong synergy between liquid and illiquid performing credit strategies. Today, Raj and Milwood will focus on the illiquid side of the equation and specifically on direct lending. Gentlemen, thanks so much for joining me today.
Thank you for having me.
Thank you.
So let's talk about what direct lending is, and I'd love to hear in your own words. Milwood, let's start with you.
Oh, I was hoping you'd start with Rod. So direct lending is really an opportunity for asset managers like ourselves to structure bilateral transactions with the borrower directly versus the traditional way of borrowers issuing debt was through a bank or through an intermediary.
Mm-hmm. What would you add, Raj?
In addition to what Milwood said, I would add a couple of things. Firstly, what is private debt? Private debt is a term people use interchangeably with direct lending sometimes, but they're different. Private debt, like the name implies, is a debt which is issued or traded in the non-public markets. Direct lending is a subset of that. Technically speaking, direct lending includes first lien, second lien, unit tranches, mezzanine, venture debt, capital financing debt, but practically speaking, the market generally refers to direct lending as senior debt to first lien unit tranches to the middle market. Technically, it's wide ranging, but investors tend to think of direct lending more as a senior tranche.
The direct lending market has exploded since the global financial crisis. High yield bonds, senior loans, those asset classes have grown, but not really in comparison.
Right.
Let's talk about what's driving that growth and then risks maybe that are hidden and embedded in that.
I think, Danielle, you use the right word to describe it. Explosive. That's the best way to describe direct lending. Depending on the source of the data, people would say the direct lending market today is around $800 billion in size. And mind you, most of the growth has occurred since the recession, since 2009 or so.
Well, the market has continued to go up since 2009. So there's really been no opportunity for private credit to reset or take a step back and say, does this make sense?
And in high yield bonds and senior loans, that growth, what we've seen is lower quality issuers accessing these markets, a decline in fundamentals. I'm sure you're seeing some of that. Tell me about the companies that you're sourcing and what that credit quality looks like today.
So it's finance is art and science, right? The art of it is your assumptions on revenue, your assumptions on EBITDA, your assumptions on valuation, and the calculation of those terms is the science part. And I think the risk is that if the actual calculation of EBITDA or cash flow over time is not what you predicted it to be, then you potentially could have a hold in terms of what that asset may be worth. And I think that's the challenge or the issue right now in our markets, in the direct lending market, is what's the real true earning streams of a business? What's the right real capitalization? What's the right leverage?
How do you protect against this? I know that there's a component of underwriting and selecting, the right opportunities, but also probably structuring and highly negotiated deals.
In this market, you're not really giving credit for pricing risk. You're pricing capital flow. And so we'd much rather not invest in a business where we can't really truly understand the risk and we can't price that risk.
That's an interesting perspective Milwood brings from his seat in terms of assessing risk and how we think about it. I tend to focus on a couple of what I would say idiosyncratic risks in the direct lending market. One is, I go back to the preface where I said direct lending is mostly thought of as senior debt. Let's start with the premise. Senior debt. Our boss, Howard Marks, will always say this, okay, senior debt. What is it senior to? That's the key question, right? Historically, when people talked about senior debt, that meant debt to EBITDA of no greater than 4 turns, 4 times debt to EBITDA. It's been for decades, right? So where are we now? if you go back to, let's say, 2013 and 14, maybe 15% of the deals were leveraged more than 4 times and call it senior debt. Today, you're probably 2/3 of the market, greater than 4 times. So what does this mean to us? It means one of two things, right? One is it's a new paradigm. Who's there to say 4 times should be senior debt? Why not 5 times senior debt today? Certainly possible, but unlikely, because just because you call it a different name, risk is not different. It's the same risk. So what is more likely is that senior lenders are taking on junior risk by going deeper in the capital structure and calling it senior. That's not the right way to assess risk for managers as well as investors. The second aspect, fund level leverage. You got leverage at the fund level. That is actually both dangerous in one way and exciting in other way if you think about the opportunity, right? This is the reason why. CLOs, Milwood might know better, it's probably 9 to 10 debt to EBITDA leverage. Your home mortgage, 3 to 1 leverage. So direct lending at 1 to 1 sounds innocent, quaintly innocent, like, wow, 1 to 1 is pretty low, but there are a couple of factors investors may not focus on it as much. One is easier. The term of the leverage is mismatched with the term of the assets. Assets are 6 to 7, the leverage is 3 to 4. So what you do, you have to refinance, but unlike your mortgage, where you can go to hundreds of banks, here there are very few institutions where you can go to get refinanced. So that's an inherent risk. The second is a little more, I hate to use the word insidious, but it may be that, which is,
Tell us more.
Most lending in the fund level for direct lending is on a deal by deal basis. So what that means is these banks who provide this leverage, most of them don't want to invest in the middle market directly, but they're more than willing to lend to direct lending managers who invest in this market. Why? Because at the first sign of trouble, which is defined as 10 to 15% decline in performance, they have a great deal of discretion to pull their leverage back. That is very limited liquidity, especially when you need it. That's a very hard thing to manage, and that's where the opportunity also arises, right? You can go both ways.
Well, maybe I'll follow that up and just ask, how did this play out, these risks, during the pandemic, 2020? Let's talk about that.
So there's the practical, and then there's the sort of what I call the textbook answer, right? And then the textbook answer would say, in moments of dislocation, right? If you love something at 100, right, you should want to marry it at 85, right? Because presumably you did the work to convince yourself to buy it at par. So if it's at 85, and the reason why it's 85 is because there's a liquidity disconnect and not necessarily an underlying credit issue, you should buy it all day long.
Your risk is possibly lower. Right.
But what happens in reality is that most investors say, well, it could go to 70, right? And so maybe I should just wait a little longer.
Is it a falling knife?
Right. And at the same time, I've got my existing portfolio now trading off. So do I really want to allocate dollars to a new situation that I may need to preserve in case something goes wrong with my existing portfolio? So the reality is no one really does anything, except for a handful of firms. The pandemic was short in terms of our assets in our market. And so all that does is say, gosh, I might as well double down on private credit or risk assets in the leveraged finance market because dislocation was short, liquidity was fine, and we all came out of it, and frankly, in probably a better place today than we were pre-pandemic. And so everything turned out fine. No one learned anything. There was no lesson learned other than I wish I'd put more money to work when a downturn happened. And I'm glad I was invested because it turned back around in a short order of time. So what does that mean now? It's almost like being in a car wreck, wearing no seatbelt, and walking out without a scratch. So I'm like, maybe I could do that again. Right? so I think
if you keep going fast and you don't crash or have to slam on the brakes we have so many times.
But I walked out of the car fine. I was fine. It was the car, it wasn't me.
I love that analogy.
So now you have, post-pandemic, you have the phenomenon being extended and probably more aggressively than pre-COVID, which then means, who's really smart? Are we smart because we price risk? Maybe. Or should we just put money to work and say the next time there's a dislocation, we'll all be fine?
Milwood hit on a bunch of points, but
So you're saying I ramble?
No, maybe I will pivot a little bit to the illiquid markets. I think Milwood hit it on the head saying the pandemic was short, at least from an economy perspective, right? This case, all hands were on deck. The economy shut down effectively end of March of 2020, and then, as Milwood said, the number one priority was managing liquidity. Number two, they cut cost dramatically starting day one. So when the third quarter of 2020 happened, even though demand was lackluster, they had plenty of liquidity, and that cut costs. Now fast forward to fourth quarter of 2020. Demand comes back extremely strong. Most of it is catch up, right? People didn't spend anything.
Sure. Excessive savings
rate, and their costs are lower. So it's a positive double whammy. Your top line is higher than you should have, and your bottom line is better than you should have. So fast forward to where we are today. Number one, the historical proxy of using recent history as a proxy for cash flow may or may not be correct, because you got periods in there where you had inflated sales, inflated profits because of cost cuts, which is not sustainable, right? You can only survive for this long.
Let's talk a little bit about where assets might not work out.
I think all sectors are risky. What leverage does is it brings operational inefficiencies to the surface because you're managing for cash. And so in good markets, you don't really have to manage for cash because someone else will bail you out. In dislocated markets, that management, that operational efficiencies really puts you to the test in terms of how things will work out. So I think the next real dislocation will be driven by not necessarily sectors or industries, but more so the leverage or the cash flow performance of the business. If you're buying a house, how much you can afford depends on the mortgage rate, right? And so if mortgage rates are really low, you can buy a really big house. If you do interest only versus P&I, you can also afford a bigger house. So I think same is true in our markets. Low interest rates, capital availability, ability to quote unquote use the art of what EBITDA is has created situations where assets just may be over levered. And so any real disruption macro will change that pretty quickly. And so that's what I think my biggest concern is, that we've just put a lot of leverage on the system, on any one business.
Any other considerations as we embark at Oaktree on managing more of these portfolios that are hybrid in nature and invest in liquid and illiquid markets?
I think you can better structure your private deals, understanding the dynamics in market flows of the public deals. And so what I think is interesting about us is, we can play in publics, but we understand publics. So there are a lot of times where we may say, wow, that private deal, it's illiquid, it's priced really tight, it's a smaller borrower, I'm probably better off going in a public, larger deal, bigger sponsor, maybe slightly less rate, but I'm in a private credit companies tend to, a lot of cases, be smaller companies. I'm probably better off in that bigger business. So sometimes we use the public markets as a gut check as to whether or not the private deal makes any sense, and vice versa.
I think that makes sense as you're assessing relative value between the two.
Yeah.
I think flexibility is the key, and having the option to move up and down the cap structure, in and out of performing markets, small companies, large companies. That is what is required in this direct lending market we're all in now. Because the next 5 years would multiple probabilities on how it will go, and you need to be as flexible as you can.
And the liquid component provides some dry powder
That's right.
too for
No
these
doubt about it.
opportunities.
That's right.
I tell investors all the time, we certainly hope you choose Oaktree as a direct lending manager, but choose somebody who can do two things. One, who can manage their portfolio when things don't go well. Two, who can invest aggressively when things don't go well. Hard to do both, you know.
And Milwood, I actually think you're very uniquely positioned in that way, given that sourcing and origination spans not only our private credit, but
Yes.
distressed debt opportunities
Yes.
elsewhere. Tell
And
me
we've
what
got-
it's like working kind of across the platform.
And we've got resources throughout the country, I think, and everyone's unique, right? And so what we try to do in the sourcing origination is hire someone for one thing they're exceptional at, right? You can find an individual that's exceptional at one thing and very good at everything else. I think that's what we try to do. And everyone is different. And I believe in diversity of thought. So like, I don't want to have 5 folks on the team who came from same firm, same schools, same background. What's the point, right? And so I think that's important when we're thinking about what's out there. And then frankly, in this market, we're setting up for the next opportunity. So we're not calling someone and saying, hey, what are the 5 deals you're working on and can I work on those? We're sort of thinking about what's your theme, what's your trends. And what I'm trying to spend time doing is how do I ensure that the next theme or trend we're in front of, and that's the value of our sourcing organization. Not to mention, the borrower doesn't really care which fund something's going to sit in, right? And so with our franchise, what we're saying is let's be capital providers, capital solutions. Let's not try to figure out what's your issue and how can we solve it versus Raj can solve this part of the problem and someone else can solve that part of the problem. And if I'm a sponsor and borrower, I'm like, okay, I don't, like, who am I talking to?
Right.
Like, what?
One
you
oak tree,
just
one
give me
unified approach.
Right, one band, one sound, right? That's the approach.
Right, very well said. Well, Milwood, Raj, great conversation with you both today. As always, so fun. And I want to thank everyone viewing. We'll see you next time.